So everyone's talking about interest rates right now, credit cards, mortgages, car loans, but small business loans don't follow the same rules. Most people think that when the Federal Reserve raises interest rates that it makes your business loan get more expensive. But in reality though, banks set their own spreads, small business loans have caps, and the Fed rate really is only a small piece of the puzzle. So I've actually been going through this process myself for my business here in New York City, and I've realized that most people overpay just because they don't know how the rates are calculated. So in this video, I'm going to break down exactly how business loans work, how they compare to mortgages and credit cards, and I'll also use real numbers. So the Federal Reserve, or the Fed, is the central bank of the United States. It's responsible for keeping the economy stable by controlling inflation, regulating banks, and setting short-term interest rates. Most people think that when the Federal Reserve raises rates, all loans get more expensive overnight. And that's true for things like car loans and credit cards and adjustable rate mortgages, but it's not true for business loans. So just for context, the Fed controls this thing called the federal funds rate. The federal funds rate is the interest rate that banks charge each other to borrow money. And it's the foundation for almost every other interest rate in the economy. So when the Fed raises or lowers this rate, it changes the cost of borrowing for everyone else. But business loans don't track the Fed rate directly, they track something called the prime rate. So the prime rate is usually 3% or so higher than the Fed funds rate, and it's specifically used as a baseline for business lending. So let's say the Fed funds rate is 5.5%, the prime rate might be 8.5%. So that's going to be the starting point for most banks when they decide your business loan rate. So the Fed obviously influences the system, but it's really on the banks to decide how to apply that base rate to your business. So every small business loan rate comes down to this simple formula. Interest rate equals prime rate plus lender spread plus risk adjustment. The prime rate is the rate that banks offer their most credit-worthy customers. Usually these are large corporations. And like I said before, it's typically about 3% higher than the Fed funds rate. The lender spread is what banks add on top of that to make money. And the risk adjustment is how they personalize the rate depending on how risky your business looks. So for example, if the prime rate is 8.5% and your bank adds a 2.5% spread, your rate is going to be 11%. And if your business has less cash flow or a limited history, they might tack on an extra 1 to 2%, and that's where the risk adjustment comes in. And that's why two different businesses can go to the same bank and apply for the same loan, but get two completely different rates. The base might be the same, but the spread and the risk adjustment are what change. So this is the part that most people don't understand. It's how the bank actually makes their profit. So banks borrow money at one rate and lend it at a higher rate. And the difference between what they pay and what they charge is called the spread. So that spread is their profit margin, and it also covers the risk of people not paying back their loans. So if the bank can borrow money at 6% and lend it to you at 10%, they're making 4%. So for example, for safer, lower risk businesses, the spread might only be 2% or so. But for riskier, maybe newer businesses that haven't proven themselves, the spread might be anywhere from 5% or even higher. So the more risk that your business represents, you're gonna have a larger spread and therefore a higher interest rate because of it. So the banks don't just make money off interest, they obviously also make money off of things like late fees. They have origination fees, which are fees that some banks have to get the loan started, but the spread is where they make their real money over time. So mortgages, business loans, credit cards, they all obviously have interest rates, but they all come from different systems. So mortgages are obviously backed by real estate, and they're also tied to long-term bond yields, and so that's why mortgages oftentimes have lower interest rates than credit cards and business loans. And honestly, it makes sense, right? Before we talked about how the banks always have to analyze risk. And so because mortgages are secured by a physical asset, being the real estate, it's less risky for the bank. You know, like if you don't pay, they could just take the house or the real estate or whatever. So that's why mortgages tend to be lower. And like I said, they're also tied to the long-term bond yields, which tend to move slowly, carry lower returns, and that's why they keep the mortgage rates relatively low. Business loans are short-term, they're often unsecured, and they're based on risk, and so business loan rates tend to be somewhere in the middle. Unsecured just means that there's no physical collateral backing the loan, so no real estate or physical equipment. The bank is just trusting your business performance. And so because of that, the lender is taking on a little bit more risk, and they're gonna price that risk into the rate. And so that's why business loans tend to be somewhere in the middle, higher than mortgage rates, but a little lower than credit card rates. So credit cards are unsecured and revolving, which makes them the riskiest of the three. And that's why some credit card rates can be 18%, 20%, or even higher. So a revolving loan means that you can borrow money, you can pay it down, and then you can borrow again. And so it's basically a cycle that never ends so long as you keep making the minimum payments. And so because of this, you can see why credit cards are the riskiest type of lending. There's no collateral, and borrowers often have a balance that they carry month to month. And so that's why credit card rates are like sky high. I think I have one credit card that's 19%. I have another that's 22%. And so yeah, credit card rates are crazy. So don't get into credit card debt. So let's do a quick recap and compare these three different types of rates. And all these numbers that I'm about to give you are at the time of recording this video. So if you're watching this in the future, I'm sorry if the rates are completely different. Mortgages are long-term and they're collateral backed. So they offer the least amount of risk for the lender. And so right now, mortgages are around 6 to 8%. Business loans are medium term. They're partially collateral backed because there's no hard asset like real estate. They're backed by your business, and they're moderate risk, depending on your business. And so they have the broadest range, I would say. They could be anywhere from 8% to 14%. And again, that's based on how risky your business is interpreted by the lender. Credit cards are revolving. They offer no collateral to the lender. And because of that, they offer the most risk to the lender. And so their rates are going to be crazy high. Credit card rates can be anywhere from 18% to 30%. So if you take anything away from this video, please do not get into credit card debt. It can completely wreck your finances. So now that you understand how rates are made, let's talk about the one type of loan that actually gives small business owners a break a little bit. We're going to talk about the SBA loan. The SBA loan is the most common small business loan backed by the US Small Business Administration. So SBA loans are issued by private banks, but they're guaranteed up to 85% by the federal government. And so this allows the banks to take on a lot less risk, which is why they're able to offer you better terms. And by better terms, I mean longer payback periods, lower rates, and smaller down payments. So the SBA, or the Small Business Administration, puts a cap on how much the bank can charge you. Most SBA loans are capped at prime plus 2.75%. And we talked before about how the prime rate is the baseline rate that banks start with. And so the SBA is telling them that they can only add an additional 2.75% to the prime rate. And so that works out in your favor because we talked before about how some business loans can get all the way up to 14%. This allows them to only add 2.75% on top of the prime rate. So let's say the prime rate is 8.5%. Your maximum rate through the SBA loan is 11.25%. And oftentimes this is by far the best deal for business owners. So to qualify for an SBA loan, you need solid credit, consistent cash flow, and you need to have been in business for at least 2 years. And if you're a newer business, you might not qualify for an SBA loan because of the 2-year requirement, but I would suggest starting to focus on your risk profile. How can you make your business less risky? Like, do you own real estate? Do you have cash saved up? Do you have proven consistent cash flow? Anything that you can do to prove to the bank that your business is less risky than they think it is going to help you. The stronger your financials are and the stronger your credit is, that's going to lower your spread, which leads to you getting a better rate. So just to recap, the Fed sets the base rate, the bank adds a spread, and you control the risk that determines how high the rate is going to go. And that's how small business loan rates actually work. And if you're a small business, odds are you're an LLC, and you might want to switch to an S Corp in order to save money on your taxes, and I talk a lot about that in this video.